Hey there! So, remember back in 2020 when Apple split its stock 5 for 1? Yeah, the stock was trading around $500 per share, and suddenly, bam, it was down to 100. Now, before you think Apple magically lost 80% of its value, let me explain something real quick. A stock split doesn't actually change the company's worth. It's kind of like taking a pizza and cutting it into more slices. You still have the same amount of pizza, it's just divided up differently. A 2-for-1 stock split means one share becomes 2 with the price cut in half. That makes the stock more affordable for everyday investors like you and me. So in this video, we're diving deep into the top 10 most split-friendly stocks in the US. We're gonna uncover their juicy post-IPO returns and see just how much money early investors made. We're talking household names here: Apple, Microsoft, Tesla, the giants. And hey, the big question is, which stock is gonna split next? Tesla? Nvidia? Drop your predictions in the comments below. First up, the tech behemoth, the one and only Apple. This company really needs no introduction. They've been around forever. Well, not literally, but since 1976. And their stock? Oh man, it's been on a wild ride. Apple has split its stock 5 times since going public in 1980. That's right, 5 times. The most recent one was that epic 5 for 1 in 2020. They also had a 2-for-1 split in 2014, another 2-for-1 in 2005, and yep, 2 more 2-for-1s back in the 80s. But here's the kicker, the mind-blowing part: if you were smart enough or lucky enough to snag just 1 share of Apple back at their IPO, hold on to your hat, because that single share would be worth, wait for it, over 250,000% more today? Yeah, that's not a typo, 250,000%. We're talking life-changing money here. Imagine buying a cup of coffee back then and ending up with a luxury car today. That's the power of Apple's stock splits and growth. Now, I'm not saying every stock split turns into a gold mine, but Apple's story really shows the potential of investing in solid companies long term. They've consistently innovated, dropped game-changing products, and kept their shareholders smiling. So the next time you see an Apple product, remember, it's not just a phone or a laptop or a watch. It's a symbol of incredible growth and the possibilities that come with smart investing. Alright, moving on to another tech titan that's been around since the dawn of personal computers, Microsoft. Bill Gates, anyone? These guys basically invented the operating system that powers most of our computers today. And their stock? Let's just say, it's been a pretty solid investment to say the least. Microsoft has had not 1, not 2, but 8 stock splits since its IPO back in 1986. They were on a roll, splitting their stock almost every other year in the 90s. The last split was in 2003. But hey, who knows what the future holds, right? But let's talk numbers, because that's what really gets investors excited. If you had the foresight to buy a single share of Microsoft back in 1986 and held on to it through all the splits and market ups and downs, congrats, because that share would have multiplied in value by over 150,000%. That's enough to turn a small investment into a seriously life-changing amount of money. Microsoft's journey is a classic example of how a company can dominate an industry, adapt to the times, and keep on thriving. They've expanded into cloud computing, gaming, and so much more, proving they're not afraid to evolve. The takeaway here? Investing in companies with a strong track record of innovation and growth can really lead to some substantial returns over time. Next up, we've got the disruptor, the innovator, the company that's pretty much single-handedly pushing the world toward electric vehicles, Tesla. Love them or hate them, you can't deny the impact Elon Musk and his team have had on the auto industry and beyond. Tesla's stock has been on an absolute tear since its IPO in 2010. It's seriously been one of the best performing stocks of the past decade, and for good reason. They went from being a niche electric car maker to a global powerhouse with a market cap that rivals the biggest names in the auto industry, and yep, they've had stock splits too. Tesla split its stock 5 for 1 in 2020, and then again 3 for 1 in 2022. Those splits made the stock more accessible to retail investors and honestly helped fuel even more growth. Since its IPO, Tesla stock is up over 15,000%. Now that's super impressive, but yeah, it's still a bit behind the astronomical returns of Apple or Microsoft. But here's the thing, Tesla is a much younger company. The big question now is, can they keep up this growth and maybe become the next Apple or Microsoft in terms of long-term returns? Only time will tell. All right, let's talk about NVIDIA, the company that's powering everything from gaming PCs to artificial intelligence. These guys make the graphics processing units, or GPUs, that are essential for high-performance computing. And their stock? Well, let's just say it's been on a rocket ship ride. NVIDIA has split its stock 5 times since going public, with the most recent split being a 4-for-1 in 2021. That's a testament to their incredible growth and the increasing demand for their products. And the returns? Hold on to your hats, because NVIDIA's post-IPO return exceeds a jaw-dropping 80,000%. That's right. If you invested in NVIDIA back in the day, you'd be sitting on a mountain of cash right now. NVIDIA's success is a prime example of how a company can capitalize on emerging trends like gaming, AI, and data centers. They've positioned themselves as the go-to provider of high-performance computing, and the market has rewarded them handsomely. Next up, we have the e-commerce behemoth, the company that's practically taken over the world of online shopping, Amazon. Jeff Bezos, anyone? From humble beginnings as an online bookstore, Amazon has become a global retail giant, disrupting industries and changing the way we shop. And their stock? Well, it's been one of the most successful investments of the past few decades. Amazon has split its stock 3 times, including a massive 20-for-1 split in 2022. That split made the stock much more accessible to retail investors, further fueling its growth. Since its IPO in 1997, Amazon's stock is up over a staggering 200,000%. That's right. If you invested in Amazon back when it was just an online bookstore, you'd be laughing all the way to the bank right now. Amazon's success is a testament to their relentless focus on customer experience, innovation, and expansion. They've gone from books to everything under the sun, and they're showing no signs of slowing down. Now let's switch gears and talk about a company that's been a household name for over a century, Coca-Cola. They're the undisputed king of sugary drinks, and their brand is recognized worldwide. But don't let their age fool you. Coca-Cola has been a surprisingly good investment over the years. Coca-Cola has split its stock a whopping 11 times since its IPO. That's right, 11 times. They've been consistently rewarding their shareholders with stock splits, making their shares more accessible and driving growth. And the returns? Coca-Cola has returned over 500,000% since its IPO. That's right, 500,000%. It's a testament to the power of brand recognition, global reach, and consistent dividends. Coca-Cola is a prime example of a blue-chip stock, a well-established, financially stable company that's been around for ages and continues to pay dividends like clockwork. All right, so next up we've got the investment vehicle of the Oracle of Omaha himself. Yep, Warren Buffett. It's Berkshire Hathaway. This massive conglomerate owns a super diverse portfolio of businesses ranging from insurance and railroads to, consumer goods. Now here's the thing. Berkshire Hathaway's Class A shares, or Barek.Akama, are like famously expensive. We're talking hundreds of thousands of dollars per share. But hey, don't worry, they've also got Class B shares, BRK.B, which were introduced through a 50-for-1 split back in 2010. And the returns? Oh man, get this. Berkshire Hathaway's Class A shares have returned over 3 million % since 1965. Yeah, you heard that right. 3 million %. That's just wild. It really shows Warren Buffett's incredible investing chops and the serious power of long-term, value-driven investing. Now, Berkshire Hathaway is kind of a unique case when it comes to stock splits. Buffett has famously avoided splitting the Class A shares, mostly because he thinks it would attract short-term traders. But creating the Class B shares? That move made investing in his company way more accessible for the average investor. All right, let's move on to another retail giant that honestly needs no introduction, Walmart. They're the world's largest retailer, known for their super low prices and just, a massive selection of goods. And you know what? Despite the rise of e-commerce and all the digital disruption, Walmart has continued to thrive. Now get this. Walmart has split its stock a whopping 11 times since its IPO. Yep, that's right, 11 times. They've consistently rewarded their shareholders with stock splits, which makes their shares more accessible and helps drive growth too. And the returns? Oh man, Walmart has returned over 1,200,000% since its IPO. That's right, over 1,000,000%. It's honestly a testament to their crazy efficient operations, massive scale, and their ability to adapt to changing consumer preferences. Walmart is just a prime example of a company that's built to last. They've weathered economic storms, embraced new tech, and continue to dominate the retail landscape like champs. All right, next up, we've got the go-to destination for, well, pretty much all things home improvement, Home Depot. They're the largest home improvement retailer in the US, and those orange aprons, yeah, they're pretty much everywhere. Home Depot has split its stock 5 times since going public, with the last split happening back in 1999. Just like Walmart, they've consistently rewarded their shareholders with stock splits, making shares more accessible and helping to fuel growth. And the returns? Home Depot has returned over 300,000% since its IPO. That's right, 300,000%. It really shows the resilience of the housing market and how Home Depot has capitalized big time on the whole DIY boom. Home Depot is a great example of a company that benefits from both professional contractors and everyday homeowners. They've built a strong brand, a huge network of stores, and a solid rep for quality products and top-notch service. And last but definitely not least, we've got the iconic fast food giant McDonald's. They're the largest fast food chain in the world, serving up billions of burgers and fries every single year. And even with changing tastes and health trends, McDonald's has managed to keep thriving. McDonald's has split its stock a whopping 12 times since its IPO. Yup, 12 times. They've consistently rewarded shareholders with splits, making shares more accessible and driving even more growth. And the returns? McDonald's has returned over 500,000% since its IPO. That's right, 500,000%. It really highlights the power of brand recognition, global reach, and those consistent dividends. McDonald's is a textbook example of a blue chip stock, a well-established, financially rock-solid company that's been around for decades and just keeps delivering dividends like clockwork. So, there you have it. The top 10 most split-friendly stocks in the US and the absolutely incredible returns they've generated for investors over the years. Now, just to be clear, stock splits themselves don't actually create wealth, but they can definitely be a sign of a company's growth and sometimes even act as a catalyst for further price appreciation. Now, I want to hear from you. Which stock do you think is primed for a split next? Could it be Tesla again? Or maybe Nvidia's gearing up for another one? Drop your predictions in the comments below. Let's see who nails it. And hey, don't miss our next video where we'll be diving deep into the stock market crystal ball and revealing our 2024 stock split predictions. You seriously won't want to miss that. As always, hit that like button, share this with your friends, and subscribe to the channel for more financial insights. Because remember, knowledge is power,